In the spring of 2020, the United States Federal Reserve used public money to buy the private investment funds of one specific company. That company designed the program. That company managed the program. And that company's CEO had spoken to the Treasury Secretary 5 times over the 48 hours before it launched. His name is Larry Fink, and most Americans have never heard of him. The question this episode answers is not whether that was legal. It was legal. The question is what it tells you about who actually runs the system. Hold that question, because the answer requires understanding something that happened 16 years earlier, in a room most people do not know exists. BlackRock is not a bank. It does not hold your deposits. It does not issue loans. It does not appear on any government list of institutions too big to fail. It is an asset management firm, which means it manages money on behalf of other people. Pension funds, sovereign wealth funds, individual retirement accounts. As of 2025, BlackRock manages $14 trillion of other people's money. That number is larger than the annual economic output of every country on Earth, except the United States and China. And the man who runs it is Larry Fink, Chairman, Chief Executive Officer, paid $37.7 million in 2025 alone. And yet in most American households, his name means nothing. That asymmetry is not an accident. It is part of how the architecture works. In 2008, the American financial system collapsed. Bear Stearns failed. Lehman Brothers failed. AIG required the largest government bailout in United States history. When the Federal Reserve needed someone to manage those toxic assets, it did not run a competitive process. It did not run a competitive bidding process. It called BlackRock. No competitive bid for the Bear Stearns vehicle. No competitive bid for the AIG vehicles. No competitive bid to evaluate the assets of Fannie Mae and Freddie Mac. Senator Chuck Grassley asked Timothy Geithner at a January 2009 Senate hearing why BlackRock was the only firm considered for these contracts. Geithner answered in 4 words. They come with a world-class reputation. 4 words. No process, no competition. $30 billion in toxic assets handed to one firm, with no public review of whether another firm could have done it better. That was 2008. The relationship only deepened from there, but the mechanism that made BlackRock untouchable was not built in Washington. It was built in 1988, in a borrowed office with 8 partners and $100 million. Larry Fink did not start powerful. He started at a bond trading desk at First Boston in 1976. He became a pioneer in mortgage-backed securities, fast. By the mid-1980s, he was one of the most profitable bond traders on Wall Street. Then, in 1986, one bad interest rate bet cost his department roughly $100 million in a single quarter. First, Boston showed him the door. Fink took 8 partners and started over in 1988. He called the new firm BlackRock. His obsession after the loss was risk. Specifically, how to see risk before it materialized. He built a risk analytics system called Aladdin. That system now monitors roughly $21 trillion in assets globally. One piece of software. Inside the risk infrastructure of banks, pension funds, and insurance companies worldwide. BlackRock manages your money. Aladdin watches the money of the firms managing everyone else's. When it went public in 1999, the stock listed at $14 a share. By the end of 2025, that stock traded above $1,000 a share. The man fired for losing $100 million. Built the system that sees more of the financial world than any other entity on Earth. But the scale did not come from Aladdin. It came from one acquisition. And what that acquisition gave BlackRock is the thing most investors fund every month without knowing it. In 2009, BlackRock purchased Barclays Global Investors for $13.5 billion. That deal included a product called iShares. iShares was the world's largest family of exchange-traded funds. Exchange-traded funds track indexes. They hold shares of every company in those indexes. And here is the detail that matters. When a fund holds shares in a company, it holds the right to vote those shares. At annual shareholder meetings, on board appointments, on executive pay packages, on corporate policy. When you put money into an index fund, you hand those votes to the fund manager. Most people do not realize this. They think they are just investing. They are also delegating. BlackRock, Vanguard, and State Street together are the top shareholders in 88% of America's largest 500 public companies. Together, they control roughly 25% of the voting shares in corporate America, not of one company, of all of them. When Larry Fink writes his annual letter to CEOs, that letter is not advice. It is a message from the entity that controls the votes, that determine whether those CEOs keep their jobs. The letter arrives, the board reads it, and they know who sent it. There is more where this came from inside the vault. The members inside the vault are already 2 episodes ahead of this. The link is below. Marcus Webb runs a small freight logistics company outside of Columbus, Ohio. He has 32 employees. He has never bought a share of anything BlackRock manages. But the bank that holds his business line of credit, BlackRock, is one of its top institutional shareholders. The fuel supplier he depends on, BlackRock votes at their annual meeting. The insurance company that covers his fleet, BlackRock owns a significant stake. His drivers' pension contributions flow into funds that hold BlackRock ETFs. Marcus never signed a contract with BlackRock. He never chose them. He never agreed to be part of this structure. And yet the decisions made inside BlackRock's proxy voting department travel through every layer of his business without him knowing. He is downstream of every decision. And so, almost certainly, are you. Now back to March of 2020. Because this is where the 2 threads of this story collide. BlackRock has the government relationship. BlackRock has the voting infrastructure. And in the spring of 2020, both of those advantages are about to be used simultaneously. The Federal Reserve announces it will buy corporate bonds. For the first time in its history, a program worth hundreds of billions of dollars. It hires BlackRock to manage the purchasing process. No competitive bid. BlackRock is also the world's largest issuer of exchange-traded funds. The program includes buying ETFs, BlackRock's ETFs, the same firm that designed the program, managed the program, and whose CEO spoke to the Treasury Secretary 5 times in the 48 hours before launch, was also the firm whose products the government was purchasing. Bloomberg reported this. The Washington Post reported this. The Federal Reserve confirmed it. BlackRock waived advisory fees on the ETF purchases. It did not waive the automatic management fees those funds generate. The bond market recovered almost overnight. BlackRock's fund prices stabilized. The people who designed the recovery profited from the recovery. That is not a conspiracy theory. That is a documented sequence of events, approved by the United States government, without competitive review. Melissa Carver was a hotel shift supervisor in Tampa, Florida. She was 43 years old in March of 2020. When her employer furloughed her, she called her retirement plan administrator. Her balance had dropped 32% in 23 days. The administrator told her to wait. 3 weeks later, the market recovered. What nobody told Melissa was that the firm managing the government's recovery program was the same firm whose ETFs the government was purchasing. To drive that recovery, she got her balance back. The mechanism that gave it back also generated fees for the firm that designed the mechanism. Melissa is not angry about this. She does not know it happened. That is the architecture. In 2025, BlackRock also managed the Thrift Savings Plan, the federal government's retirement fund for 5 million federal employees. The same firm, advising the Federal Reserve on financial markets, manages the retirement savings of the government employees who work for the Federal Reserve. The same firm that received no-bid crisis contracts from the federal government holds the retirement savings of federal workers. One firm, both sides, every time. And last year, that firm paid its CEO $37.7 million, a 23% raise. After a proxy advisory firm publicly recommended shareholders vote against the pay package, shareholders voted for it anyway, with 67% support. The institutions voting in favor of that pay package, many of them are the same types of funds, whose own voting power BlackRock controls. Now here is the answer to the question planted at the start. Who is BlackRock working for? The legal answer is the clients. It is a fiduciary, legally obligated to act in the interests of the people whose money it manages. That is real. And it is also incomplete, because the same firm managing your pension fund is also the preferred crisis contractor of the United States government. The same firm holding your index fund votes is also the entity whose annual letter tells corporate America how to behave. The same firm that received no-bid contracts during both major crises of this century grew to $14 trillion in assets during those same crises. None of this required a conspiracy. It required proximity. It required a phone number that got answered. It required being the only firm in the room when the room needed someone. That is not a crime. That is something more durable than a crime. It is position. And when one firm holds that position across every layer of the financial system simultaneously, the question is not whether the system is working. The question is working for whom. That is BlackRock. That is the architecture. If you are the kind of person who wants to see the architecture, and not just the headlines, you belong here. Most people see the news. We show you who built it, subscribe, and stay ahead of it. Welcome to Luxona.